Welcome to our October 23rd meeting of the Retirement System Investment Commission. First order of business is adoption of proposed agenda. Is there a motion?
So moved.
Second? Any discussion?
Mr. Chairman,
yes.
it's my understanding there was going to be a motion to amend the agenda.
Okay, I believe there is going to be a motion to amend the agenda. Can we have that motion?
I move.
Second?
We have to say
Wait, to amend it how?
we have to say how we're amending.
All right.
So I'd like to move that we amend the proposed agenda to move item 7B1 related to the Azalea investment into executive session.
Second.
Is there a second?
Second.
Any discussion? Hearing none. All those in favor signify by saying aye.
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 Vote? No? It's unanimous.
All right, so motion is passed.
Okay.
We'll now move on to the approval of the minutes of the August 25th, 14 meeting. Do I have a motion?
So moved.
And a second?
Second.
Any discussion? Any deletions, corrections? Hearing none. All those in favor of approval signify please by saying aye.
Aye.
Aye. None opposed, so it is unanimous.
Unanimous.
And we will now move on to the second item, the Chairman's report, which is approval of the commission meeting schedule for 2015, which you all have available and you can see. Any questions on the proposed meeting schedule?
Just need a motion to adopt that.
Then, if there are none, may we have a motion to adopt the meeting schedule?
So moved.
May I have a second?
Second.
Any discussion? Hearing none, all those in favor signify please by saying aye.
Aye.
Again, it's unanimous. Second item is committee composition. At this particular time, the committees will remain as is.
Well, wouldn't we need to take a vote on that?
Yeah, I'm sorry, Mike, go ahead.
I think you didn't need to mention that
Sure, yeah. If anyone has a desire to serve on any committee, please communicate that, and we will certainly consider that.
Yeah, I mean, I was just kind of thinking on a couple of things. I mean, one, eventually kind of a plan to, I think some committee turnover is a good thing, right? I mean, I've now been on audit for, I guess, 2 years, right? So at some point, kind of rotating off. Second thing, just in terms of, Peggy serves on that committee ex officio by standing, but I think, we have the Human Resources and Compensation Committee. Just given the frequency of some of these subcommittees and sort of the nature of that, I think it'd be appropriate to have the PEBA member, serving on that committee, as well. I mean, they're here, they're closer, more frequent as the staff has grown. So in terms of the composition of that committee, that was something that I think, worthy of discussion.
Any other comments? If not, I don't think we need a vote on that, do we?
Well, why don't you suggest that if we have a meeting on November 20th, if members are interested in serving on other committees and want to get off of the committees that they want,
We know before that.
you just
When
bring
is
it
the
to our
meeting on the
attention.
20th?
November the 20th, bring that to our attention, and we'll.
All right.
And we'll
Mike just reminded me that there will be an HR committee meeting on November the 20th.
Our meeting is November.
Oh, I'm sorry.
Yes.
The commission meeting on November the 20th. So if anyone has any suggestions or recommendations prior to that, please let us know, and we'll
Yeah,
discuss it.
including Mr. Gillespie.
If we could just kind of clarify, our policy, right? Because we've reviewed all our policies, and basically our policy says, look, the chairman of the commission will, in essence, do a nominated slate, right? But it's kind of silent on the issue of when there's a changeover, right?
Yeah.
At which we had the changeover. And then secondly, what is the process here, right? We shouldn't just take the committees as a given. We're supposed to get a slate and we're supposed to vote on them, right? And instead, we've just kind of rolled everything forward. But I think we need to clarify what that how those are, because there's an inconsistency with how our policies are written,
Is
right?
it,
Or, you know, silent on the issue.
is it, in the corporate governance, is it
Mm-hmm.
a vote required by the full commission to approve the committee? I don't.
Yeah.
Is
Yeah,
it-
it
is
says
it?
the chairman, effectively,
Chairman.
it says chairman will
Right.
present a slate with the advice and approval of the commission,
Okay.
right?
So, yeah.
All right, well then, fine. Prior to November the 20th meeting, if anybody has any suggestions or nominations, please make those known.
Okay.
Very good, all right. We will now move on.
And I think we also should put language in about carryover, right? When there's a change of chairmanship of the commission, that we will in essence keep I think we need to update the general governance
Change the
policy
policies.
to have that carryover, right?
The
Okay.
timing,
Okay.
address
I mean,
the timing issue.
Yeah.
If I may, Mr. Chairman, I
Yes.
think that that's really just would be a natural occurrence, because I'm not sure if the governance policy requires if it's triggered, if the selection of a new slate is triggered by the changeover in chairmanship.
It's
So,
silent right now.
yeah, so I think this is a natural kind of, general governance principle. The slate everybody would carry over in their positions until, but I think that I think your suggestions will put that having some type of triggering mechanism to reconsider that is something that we should look at, so.
Okay, we'll do that prior to the next meeting.
Yes,
Okay, very good. All right, let's move on to the executive director's report.
Thank you, Mr. Chairman. Really, the only thing that I have scheduled for my report, just to give the commission an update on the two outstanding RFPs that we have, the two major ones that we have, just to let the commission know that the compensation consultant RFP is at procurement. They told us on Tuesday that they expect to be assigned to a procurement officer this week. They've also indicated that they will try hard to accelerate the process for us. As we know, in reissuing this RFP, we've benefited greatly from having John Farmer on staff, and I think that we'll have an excellent result as coming out of that RFP, and once we get the deliverables. As you know, the contracts will be for 3 years. Probably looking to get our first deliverable from that in the spring, and we've hopefully sometime around April, and we have a budget for $60,000 per year for that. The risk RFP, the vendors have been narrowed down to, I believe, just a single vendor. We're working with procurement to negotiate the terms of that contract. The contract would be for 7 years with an option to terminate. Hopefully, we'll have that negotiation process done within the next month or so, and we have budgeted $300,000 per year for that. So I just wanted to give the commission an update on those statuses, since I think we had talked about those at the last commission meeting. And that's all I have for my report, Mr. Chairman.
Thank you. Any questions on that? If not, okay, we'll move on to the Human Resources and Compensation Committee report. And can tell you that the HRC committee met on October 10th, 2014. Following the executive session portion of the meeting, the HR committee formally confirmed that the individual assessments by the CIO relating to PIC payments, as required by the compensation policy and previously discussed by the HR committee, had been fulfilled. The HR committee will provide the commission with additional information relating to matters discussed during the committee's executive session during the executive session portion of the commission meeting.
And
All right.
so next will be Audit Committee, Mr. Chairman.
Next, we'll move on to the audit committee report.
So kind of related to that, audit committee has not met since our last meeting, but the updates, we did go ahead and post the ERM position. I believe that was posted Monday. Is that right? Is John here? That was posted on Monday. Starting to get a few resumes in. Hopefully, we'll see more. There was a few audit reports posted related to the PIC payment. So audit, is Monica here?
Yes.
Yeah. So, you want to speak to that?
Yeah, that'll be, I think, discussed as needed in the executive session as well.
Actually, no. Am I right? Is that open or closed? It's open.
If you are going to discuss the details of it, it's in a report. There's an attachment to that report that would probably be confidential to you guys. So you tell me.
Is there a high-level summary that you could,
Oh, sure, I could just kind of give a verbal.
just overall?
Sure. Overall, what the report found is that we found no material exceptions as it related to the compensation calculation that was performed. We found it to be actual and factual as well. There was one observation in that we found the policy needed to be clarified and delineated to really allow more specificity in how we determine, pick recommendations in the future. And I believe that the compensation RFP is going to be addressing that, and we were fine with management's action plan to do that.
Other than that, nothing else from audit.
Okay, thank you.
CIO?
All right, and if there's nothing more on audit, then we will move on to the Chief Investment Officer's report. Herschel?
Thank you, Mr. Chairman. Today on the agenda, we do have several investment recommendations. We had a couple that have actually been delayed. One which was noticed to the commission that there's some organizational changes that one of the recommendations, so that will require some additional due diligence and possibly be added to the agenda for November. Also, a little bit later today, we have two of our strategic partnerships who will be presenting their views on the markets and the industries that they serve and work in. Then also, they will give an update on the specific strategic partnerships themselves and some of the performance there, because there are some confidential or material, non-public information, if you will, on some of the investments. Portions of that will be in executive session. Also, with respect to performance update, the numbers have improved from last week, if you will, on an estimated basis. So if we took the snapshot last week, we were down a little over 2%. There has been some recovery in the markets, so we're down fiscal year to date about 130 basis points, or 1.3%, compared to a benchmark of being down about 2%. Again, we're using estimates for September and October. So you've seen a lot of market volatility, and some of that start to come back out as you've seen this V recovery, if you will, in the equity markets. Our belief is a lot of that's been driven by the expectation of slower growth out of China as well as Europe, and that the inflation concerns are diminishing, where it's becoming more of a deflationary offset, and stimulus will continue to be in the market. So from a positioning perspective, the portfolio is still overweight relative to the opportunistic component of the plan, which would be GAA strategies, the hedge fund strategies, and overweight to core fixed income. Those are offset by underweights to private debt as well as real estate. And just as a reminder, the private debt and the real estate, those are call-down structures. So it's just the timing of getting those assets into the ground. So the two overweights represent more of an offset to those two asset classes. With that said, from a weighting differential with respect to the plan versus the policy, those four that I discussed are 1 to 1.5%. So still within the ranges, but beyond the policy benchmark itself. All the other asset classes are within 50 basis points. So we're still running very, very tight to the policy benchmark right now. And I'll pause there for any questions. And Brady, I'm not sure if you had some comments you wanted to add to that.
No, I mean, in light of the meeting 3 weeks ago and the fact that we don't have full third quarter results, we'll present those in November. We have no additional comments at this time.
I would just add, I was in New York last week and met with a number of investment people, and the overriding sentiment that I heard from them was that much of the market turmoil was related not so much to the Ebola situation, which of course had all the headlines, but a general lack of confidence in what was happening in Washington and in general in terms of the political atmosphere. They felt that there was a general lack of confidence that needed to be rectified, and that if that could be improved, certainly that would be a significant factor in allowing the market to move forward. But they felt confidence was not where it should be, So that's something I think that we'll just have to see how it plays out. But the economics of it are certainly a little more positive, and I think that's been borne out, as Herschel has said. So the other thing that I did hear was I did not hear a lot of positive comments on China. Some of the people that I talked to who have the ability to invest in China either are not moving forward with investments in China, or certainly taking a very hard look at whether, in fact, they have any desire to be involved there under present conditions for a variety of reasons. So much of what we hear about growth in China is tempered by the fact that there is a considerable amount of skepticism in terms of the reliability of the numbers that we get out of China and the actual growth rates that we're hearing about. So the China situation seems to be one that's not as robust as perhaps we would have thought maybe just a year ago.
I wanted to ask if you think that economic conditions have changed to the extent that we might be looking at major changes in the asset allocation?
Right now, the way we're tilted, we're still within the portfolio more U.S. biased, if you will. So we think the U.S. is the strongest economy, and we continue to lean towards that way from a growth perspective. And we believe that from the accommodative perspective, we do believe that QE will unwind. So that in itself gives some pressure to increase in rates. So I think that could increase some additional volatility in the equity markets. With that said, I still believe that the U.S. is the strongest economy out there. So I think you continue to have key concerns within Europe, and I think that's where our largest concern is right now. And so we've actually, as we talked about, I think last commission meeting as well, with respect to our equity exposure there, we actually have the euro part hedged out, so it's back to the dollar currency. So we still have the equity market risk within Europe, but we don't have the currency risk, or significant reduction in the currency risk within Europe. Within China, we would agree that I don't think you're going to necessarily negative growth rates, but they are falling. I think it'll still be positive, but still, if you're going from a 6 or 7% growth rate to something half of that, that will have an economic impact as well. At this point, I don't foresee significant changes to the asset allocation discussion for next commission meeting. I think some of the ways we implement the asset allocation could change as well.
Thank you.
Anything further, Herschel?
I think that really concludes the comments for that section with respect to the CIO comments and update from HEK. And if the commission is ready, we can move to the statement of investment beliefs.
No further questions for Herschel. Let him proceed.
So one of the things we wanted to do as a follow-up from the June retreat is when we had presented the commission with a draft of the investment beliefs, which actually are behind this as well. So these are revised investment beliefs based off of those discussions, and some of the follow-up there was to actually make it a little more straightforward, more condensed, and so that's our goal here. So what we tried to do is also include all the key components of what we believe make up a very sound investment principles and the way we actually approach investing. So one of the key things, the first thing is you cannot forget who you're investing money for. So you have to understand the design of the pension plan, the liability stream. So what are the growth rates and assumptions expected there as you're designing your asset allocation. So those are all the key things of knowing your client, if you will, that have to come first. Off of that information, we then start to design an asset allocation to help us invest the assets. And that's really what bullet point number 2 starts to bring home, that we believe that asset allocation is going to be the primary driver and determinant of risk and return over the long term. Diversification is going to be key, so we don't want to just have one risk factor within the portfolio. We want to be diversified across those risk characteristics. And also we need to recognize that where we're currently at within the market cycle, is that we are going to have to invest in assets that have more risk than short-duration Treasury bonds if we want to have a chance of earning 7.5%. Also, recognizing that in certain environments, while we do have a long-term horizon, that we will experience negative investment results, and that's going to be a function of being takers of the market pricing, if you will. So again, diversification and constant monitoring are key to these activities. I do believe that there's a higher degree of market efficiency. With that said, dislocations do occur, and those dislocations create opportunities for investing in assets that are selling at a discount. Active management. If managers or managers with a certain type of strategy demonstrate that there can actually be what we'll call alpha, consistently produced on a net of fee and risk-adjusted basis, then it makes sense to invest in an active management strategy. If not, then we should look for passive implementation. And then also from a cultural perspective of continuing to challenge our assumptions, where are we at today, and those kind of discussions will continue to help us focus and make better decisions. So this is a summary of the investment beliefs, and again, we've tried to capture all the critical elements from the prior 10 points that we had, which had a lot more detail around them. So again, I present this as a draft and welcome comments, whether in the commission meeting or if someone wishes to send them to me, and we can bring those back to the commission in a couple of weeks.
I think these are a lot better. I mean, only really two comments, right? I mean, one is on number 2, asset allocation being the primary driver of risk and return. And the literature is actually, it's the primary determinant of the variance of the portfolio, right? I mean, what actually drives returns and other things are economic factors, right? Not portfolio construction factors. And then the other one would be kind of 4, right? Markets are efficient, and yet, with private activity, your ability to access them can be impaired, right? Or, I mean, it leads to a different approach of, are we going to spray the waterfront, across managers, right? In essence, create a private index, or are you, trying to be more active? So, I mean, I think maybe number 4 needs to be fleshed out a little bit between private market activities and public market activities, because there is a public-private arb situation, particularly in real estate. I mean, it's one of the things, good real estate players constantly do. Right? I mean, they'll play in the private markets, and then when the public markets get too hot, they'll flip it out as a REIT, right? So I think 4 needs to maybe be fleshed out a little bit more around public and private markets.
Any other comments? Anything further, Herschel?
So from that item, no, sir, Mr. Chairman, I think that concludes the remarks there. And then it would be time for the investment recommendations. So as mentioned, we do have several things to discuss today. The first one is the Guggenheim, which is a multi-sector credit strategy. Steve Marino will be presenting that. So he's right behind me. Steve is an officer on staff and has been with us for over a year now. And good. I'll turn it over to you.
Good morning. As Herschel said, my name is Steve Marino, and I'll be presenting today the first of a series of new credit investments that will lay the foundation for the mixed credit asset allocation plan as detailed at the June planning meeting. We identified and are recommending an investment in Guggenheim Partners Investment Management in their multi-credit strategy and a separately managed account framework in bank at the Bank of New York Mellon. Today I'll outline the process, the rationale, the investment considerations that led to this recommendation. I'll be happy to answer any questions that you may have along the way or following my comments. And in addition, I worked with Ashley Aslan on this, and we partnered on this search, so I wanted to recognize that. So before we get into it, I think it's beneficial to revisit the mixed credit policy benchmark as well as the asset allocation plan. So we have a 6% target allocation to the mixed credit bucket. That's constructed by equal parts of high yield bonds, leveraged loans, as well as mortgage-backed securities, which broadly represent the structured credit universe. So the asset class plan, as detailed at June planning meeting, outlined 3 different types of managers. We had specialist managers, which will be focused on single credit sectors, so bonds, loans, and structured credit. Opportunistic managers, which are more hedge fund-like vehicles, and then the multi-sector credit manager, which will manage across the breadth of structured credit loans and bonds. These managers will aim to add value from both top-down tactical allocations across sectors, as well as bottom-up fundamental security selection within each sector. At the onset of the search, our goals were first to identify managers that had macroeconomic capabilities that could broadly influence the tactical sector allocations. It was also important to identify managers that had capabilities across the credit universe, so within high yield bank loans and structured credit specifically, and also that those that had top-ranked teams within those individual categories. In addition, we wanted strategies that would complement and enhance the current implementation of a mixed credit portfolio by reducing volatility, diversifying the credit exposures, as well as enhancing the consistency of excess returns. And last, to identify managers and strategies that could do this all for a competitive fee. I'll take a couple minutes just to describe the process that we undertook to identify and select Guggenheim. We started with a list of 9 potential managers and strategies. We came up with this through conversations with HEK, conversations with existing partnerships, as well as internal analytics. We then pared that down through phone meetings, exposure, returns, and attribution analysis, as well as a focus on strategy and portfolio fit. And lastly, we conducted on-site visits with these managers. We met with portfolio managers, analysts, sector heads. We reviewed individual credits, as well as observed credit team meetings. And this strategy was reviewed by our internal operational due diligence and was a buy rate at HEK. So changing gears, I'll now move on to the firm, the strategy, as well as the investment philosophy, and how this strategy will satisfy the goals of the search. So to start, Guggenheim was established in 1999, and they primarily manage insurance assets. And through acquisition as well as organic growth, they diversified their product mix, moving from credit as well into equity and alternative strategies, diversified their client base, increasing their pension and endowment assets, as well as diversifying their delivery mix, moving into mutual funds as well as ETFs. The firm has offices in Santa Monica, California, New York City, as well as Chicago. Ashley and I visited both Santa Monica and New York City offices. Approximately $130 billion of fixed income assets, and that's supported by 160 fixed income professionals. More than 50% of their assets is in diversified credit strategies, which is where the multi-credit strategy will be categorized. And in addition, the firm is headed by Scott Minard. He's their CIO and is highly regarded within the fixed income community, as well as the financial community, and is currently an advisor to the New York Federal Reserve, as well as the OECD. Lastly, the firm is privately held and 47% employee-owned. So to better understand the strategy and Guggenheim's approach to multi-sector investing, I think it's important to understand Guggenheim's investment philosophies. First, they believe that fixed income markets are inefficient, and especially when they invest in off-benchmark securities, which is where they focus their attention. Guggenheim will leverage their large credit team as well as their industry relationships to source as well as analyze these offerings. In addition, they believe that indices are not created to maximize risk-adjusted returns, but rather to represent a broad market. And they believe that taking deviations from benchmark sector allocations or tactical tilts and deviations from benchmark securities can create opportunities to outperform the benchmark with a lower level of risk. And last, that buying securities to own until maturity will enhance the risk-adjusted return profile, and believe that performing extensive credit analysis prior to owning a security will prevent impulsive decision-making in the event that markets do dislocate, and that they focus on relative value analysis to really drive their buying and selling decisions. The strategy does utilize Guggenheim's strengths as both a top-down allocator and a bottom-up credit picker. Generally, when we hire investment managers, we'll hire them to do one of the two things, either pick securities within a specific market or pick sectors or markets within a defined universe. And in this case, we're getting both. And this strategy has generated strong returns by allocating thematically across markets to the most attractive sectors as well as the most attractive securities. So moving on to the team, from the top, Scott Minard and Ann Mathias lead an independent team of 8 economists and analysts. They're charged with solely analyzing and forecasting macroeconomic conditions, credit conditions, and the place and expected duration within the current credit cycle. And this informs the asset allocation and security level analysis. From the bottom, they have a large credit research staff that's enhanced by the expertise of 12 dedicated lawyers there to help analyze bond indentures, credit agreements, and covenants to help better understand and identify the risks of the individual securities. Credit analysts are organized by credit sector teams. Each sector has its own independent credit committee, which will approve as well as remove credits from an approved list. And lastly, the firm maintains a database of over 1,700 issuers and re-underwrites these issuers at least quarterly. The views from the top and the bottom all come together through the portfolio construction group, and this is led by Assistant CIO Ann Walsh. The portfolio construction group will perform relative value analysis at the sector level, and this will help inform the optimal sector allocations at the portfolio level. I do want to emphasize this point that the macroeconomic team, the systematic portfolio construction process, as well as the dedicated legal staff were all key differentiators that separated Guggenheim from the managers that we went to visit. They had many good credit shops out there, but Guggenheim's dedicated resources to the macroeconomics team, as well as their systematic approach to combining the themes from the top and the bottom, separated them from the rest. And lastly, James Michael and Stephen Brown will be co-portfolio managers on this, and they'll implement the portfolio through the guidelines and constraints that we provide, as well as being influenced by the allocation developed by the portfolio construction group and the securities from the sector level teams. Before I go on, I do just want to provide a quick update. Last week, we were informed that a member of the corporate credit committee is retiring and moving on to a second career outside of investments. He's actually moving into a movie production business, and Guggenheim has since elevated a senior member of the research team to the credit committee. He was formerly the co-head of corporate credit research, and now will be the head of corporate credit research. We spent considerable amount of time internally, as well as with HEK, and are comfortable with the committee composition and their processes. As always, we'll continue to monitor any additional departures, but do not believe this to be detrimental to the strategy. And on a positive note, the system did work very well. We were informed by both Guggenheim and HEK the day that the departure was announced. So moving on, from a portfolio perspective, an allocation in the strategy will aim to enhance the current long-only mixed credit portfolio by diversifying credit exposures and rotating into and out of the most and least attractive credit sectors. You'll notice in the red box to the right that Guggenheim, when included with the current long-only mixed credit portfolio, reduces the volatility, increases the risk-adjusted returns, and increases the consistency of excess returns. And we can see this in the portfolio beta moving from 0.16 to 0.12, the Sharpe ratio increasing 0.68 to 0.99, and the information ratio, which is 0.14 to 0.6, implying the consistency of their excess return generation. So the last of the goals led us to fees, and at the initial time of dialogue, Guggenheim's mixed credit strategy was priced with a 1% management fee and a 10% performance fee for a commingled fund. Through a series of negotiations that were led by Ashley in the back, staff came to terms with Guggenheim for a tiered fee schedule with an effective management fee of 42.5 basis points for an anticipated $400 million mandate and the elimination of performance fees. The estimated management fee savings on an annual basis were $2.3 million, and this does not account for the reduction in the performance-related fees. Along the way, we did identify risks and considerations with Guggenheim and the strategy. They're detailed on this slide. The first being that firm AUM has grown rapidly since 2009. More than doubling, actually. And we became comfortable with this, mainly because Guggenheim has kept pace with their fixed income dedicated investment staff over the same period. They aim to hire staff ahead of asset growth and, in addition, have a robust analyst training and rotational program that is used to recruit recent undergrad as well as graduate students to build and promote their credit talent from within. In addition, this is a high tracking error strategy. We're comfortable with this because the asset class plan seeks a manager that can take tactical deviations and make tactical decisions that can influence the mixed credit portfolio at the portfolio level as a whole. In addition, while the strategy tracking error to the benchmark is north of 500 basis points, the mixed credit portfolio will benefit from the low correlation between the strategy and the current implementation, ultimately reducing the combined tracking error as well as the excess return profile. And lastly, just given the concerns about where we are in the place in the credit cycle, we're concerned if now is the time to be making an investment in credit. And aside from this being a strategic allocation to credit, we are allowing Guggenheim guideline flexibility to move up and down in credit quality, up and down in capital structure, as well as to seek safer assets in sectors ahead of periods of stress, including treasuries and investment grade credits. This is all an attempt to provide downside protection and leveraging the insights of the macroeconomic research team. The strategy, in addition, has a historical correlation to the S&P 500 of between 0.5 and 0.6 back to 2007. So in addition to the information provided in my comments today, a full due diligence memo and supporting documentation was posted to WatchDocs. The strategy and firm were reviewed by our internal operational due diligence as well as provided a buy rating by HEK. Staff is recommending an investment up to 3% of plan assets with an anticipated initial funding of $400 million to Guggenheim's multi-credit strategy in a separately managed account at the Bank of New York Mellon. To recap, this strategy, if approved, will provide the foundation for implementing the asset class plan. We believe Guggenheim Partners Investment Management, leveraging their macroeconomic capabilities, their fundamental credit work, as well as their portfolio construction process, will enhance the current mixed credit portfolio and do so at a competitive fee. I'll pause now, and if anyone has any questions, I'm welcome to take them. Thank you.
I noticed HEK had rated them very, very high on everything, except they noted that the terms and conditions, their stated fees were relatively high, but we had negotiated a very favorable fee structure. I was just wondering if you could tell us a little bit, speak to that, how our negotiated fee structure compares to, I guess, normal fee structures that they might set forth.
Yeah, so the initial structure was 1% and 10%, and this was for a commingled strategy. Because they are trying to really build their pension and endowment business, I think we were able to negotiate effectively to get a competitive fee rate. And likely is probably overpriced for the pension and endowment community, and I think that was duly noted by them as well.
Yeah, I mean, I would just reinforce the savings that the team has negotiated. So we did give them a 2, which is less than favorable, but based on the standard fee offering of 1 and 10%. Steve had just mentioned that Ashley and he had negotiated a fee that's about 42.5 basis points flat. So going from 100 basis points to 42.5 and removing the incentive is a pretty significant change. So I think they deserve a lot of credit. And our rating is applied for the offering in general. I think it's safe to say that a discount of about 60% on the standard fee would boost that rating to a pretty favorable one. So I think they deserve a lot of credit for tightening the screws there.
That's great, thank you.
Any other questions, Steve?
Thank you.
Not, motion?
Yes, sir.
All right, go ahead.
Mr. Chairman, the Guggenheim motion that's been provided would be to adopt the recommendation of the CIO and the Internal Investment Committee as set forth in the summary terms chart on page 1 of the due diligence report dated October 23, 2014. 2, authorize an investment up to 3% of total plan assets into the Guggenheim multi-credit strategy through the use of a separately managed account agreement with an anticipated investment of $400 million. 3, authorize the chairman or his designee to negotiate and execute any necessary documents to implement the investment as approved by the commission. 1, upon documented approval for legal sufficiency by RSIC Legal, and 2, upon expiration of the 3 business day review period as approved by the commission on May 1st, 2014, or as the review period may be amended or superseded by the commission. 4, authorize the chairman and/or the CIO or their designees to thereafter authorize the custodian of funds to transfer such funds as are necessary to meet the obligations of the South Carolina Retirement Investment, or South Carolina Retirement Systems Trust funds with respect to the investment. Second.
Second.
Any further discussion? Hearing none. All those in favor of this investment signify please by saying aye.
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 It was unanimous?
I believe it's unanimous.
Yes.
Thank you.
All right, now do we want to move on to global equity?
Yes, sir. Move on to the
I
next
will
meeting.
now move on to global equity.
Mr. Chairman, this is really an update with respect to Earnest Partners. It's non-U.S. developed market equity strategy that was approved several years ago by the Investment Commission. That approval allowed for closing in a separate account or utilizing the Lighthouse platform to close the investment. During that period of time was also where we're looking at the master trust documentation, as well as there were the lawsuit at that point in time with Bank of New York was still going on. So we elected to close that in the Lighthouse platform. Now we're at a point that the lawsuits and things are beyond us, so we would recommend moving and transitioning the Earnest Partners equity account, global equity account, from the Lighthouse platform to an in-bank asset, if you will, at Bank of New York, which will require an investment management agreement. So that would be a good.
If I may?
Yes.
I believe you're just informing the commission.
Yes.
Yeah.
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 That we'll we'll go through the transition. So,
Since this is just informational, it does not require a motion or a vote.
correct. No motion is required, but we did want to inform the commission.
Thank you, Mr. Ferguson. All right, Michael, what do we-
Next would be the, next on the agenda is the strategic partnership presentations.
So we're running well ahead of schedule.
You want to take 5 minutes just to let them get in here?
Okay.
Or you want to?
So I've been informed that our guests are here.
Okay.
So we'll take just a moment to.
All right, you want to take a couple of minutes to let them
One man relief.
get to, all right, we'll take,
Yeah, 5
how about
minutes.
5 minutes?
I'm gonna have to be 10 minutes late more often.
Reconvened. And we're going to have a presentation from, for our strategic partnership presentations.
Yes, sir.
Herschel, do you want to make the appropriate introductions?
So, Mr. Chairman, so next up will be Apollo. So it's a strategic partnership where the commission has committed $1.5 billion. It's been in place for several years, been very successful. Also, Jim Zelter was here about a year ago and gave an update, I believe, on credit markets. So I've actually asked Adam Jordan, since he's worked very closely with Apollo and the relationship, if he would like to give the introduction comments as well.
Thank you, Herschel. We're fortunate to have Jim Zelter from Apollo with us here today. Apollo manages over $160 billion across their private equity, credit, and real estate platform. They invest over $1.1 billion for the South Carolina retirement system. Jim joined Apollo in 2006. He is currently the managing director of Apollo's credit business. He is also the chief executive officer of their BDC, Apollo Investment Corporation. Prior to joining Apollo, Jim was with Citigroup, serving as the chief investment officer of Citigroup Alternative Investments. Before joining Citigroup in 1994, Jim was a high-yield trader at Goldman Sachs. He has a degree in economics from Duke University, and he's also a board member of the investment management company that oversees the Duke Endowment and the Duke Foundation. Jim, welcome. Thanks for being with us. Great, thank you.
Thank you, Herschel and Adam, and to the rest of the board members. I think I've met many of you, but it's a pleasure to be here today, and we certainly appreciate the time of having this intimate discussion publicly first, and then with the executive committee later on in session. Just to start with, as Adam said, we are fortunate that many years ago the leadership in this organization and the leadership of Apollo came together. And from our perspective, the dialogue and the economic results have been very, very strong. And we certainly appreciate the long-term partnership, but also the dialogue we've been able to maintain and have an ongoing dialogue day to day, week to week with the commission and with the organization. I'm just going to spend a couple of minutes walking through what I think are some driving aspects of the markets today. I'm going to talk a little bit about what we see going on, the big secular move, but then certainly this is always meant to be a very open, transparent dialogue, so certainly feel free to interrupt at any point in time and interrupt for discussions. Just a moment, like Adam said, just so you know where our perspective is. I'm fortunate we sit across a large credit platform. We run about $105, $110 billion in credit today. That's all we do. We're not a global macro investor. We're not an equity long short. But everything from lending money to corporations that are AAA for AAA CLOs, all the way down to buying distressed portfolios in Europe, that's what we do. And we have got over 150 people around the globe dedicated to this business, and we operate in one integrated unit, and it's a very much of, we don't have a star system, it's very much investment committee, memo-driven, very methodical investment process. The next page, I think I've shown this, shared with this in the past, but basically we have a view that there are three major drivers impacting investors today. And whether you're the commission here today or an endowment in the U.S. or a sovereign wealth fund, I believe these driving factors really impact how you allocate capital across a variety of asset classes. And the first of which is the impact of secular change on the banking system today. We live in a world, 7 billion people, a $76 trillion economy. The U.S. and China are about a third of that. And the reality is the banks today are appropriately being regulated to being utilities. If you look at the global markets as a whole, it's about 230 trillion in assets, 75 billion of equity, 75 trillion of equity, and the rest is bonds and loans. So if banks, who are the largest player in the largest part of the global 230 trillion economy, you need to understand that. And I believe that as an investor like South Carolina, 5 or 10 years ago, the decision would be whether we want to be in high yield, we want to be in distressed. It was very binary. Now it's much more of a permanent discussion, how credit interacts with your overall portfolio. The second big theme on the top, I believe we're 3 or 4 years into a 10-year deleveraging, which is going to occur if you really look at it around Europe. Germany was not a leveraged economy, but Spain, Italy, France, the other countries, and I think you're going to find a lot of leverage if commodity prices change in the third world. How that deleveraging impacts you as an investor, I believe it means lower returns and lower rates, but we will see the impact of that. But those are two big drivers. And the third is the investor demand for yield. We can argue that there's $15 trillion of central bank credit involved with what's gone on in the last 3 to 5 years between Japan, between the European institutions, and between the U.S. But the reality is that's going to have an impact on rates for a long time. And we believe, or I believe, that we're fortunate at Apollo. I believe we're in the crossroads of credit. So what credit meant 5 or 10 years ago is a much, much broader definition than it ever has been before. And I think, as I said before, if you're an endowment today really understanding, or an institutional investor really understanding that, it's critical to how you asset allocate your entire portfolio. The next page is really, I think that many investors were micro investors. They really weren't cognizant of the global economy up until the ascent of China. And I look at my career, I started in 1984. I've been fortunate to be involved in finance in a backdrop of interest rates. But certainly the impact of China over the last 10 years cannot be diminished. But I think today investors are much more knowledgeable and understanding of where the global markets are in relation to one another and where they are in a changing period. And I would really urge the members here today to think about this slide in the sense of, I believe these are the 4 cycles that every economy goes through. And what we've done is we've put where countries were in 2011 versus where they are in 2014. And the reason why I say that is because when you think about the economies on a stage, certainly where the U.S. and the U.K. and Spain were in 2011, the bubble had burst. We were in a deleveraging period. And I would argue, as you can see, where the U.S. and the U.K. were at the top of this chart in the circle, we've really morphed all the way down from basically midnight or noon to 8 p.m. or 7:30, 8 p.m. And I think what that's really telling us is we are late in the leverage cycle. I don't think that's any great surprise in the U.S. Certainly, I would argue countries like a Brazil or a China have probably gone close to where the bubble has burst to a great degree. And a country like Spain or Ireland have really been the leaders in Europe in terms of deleveraging. And I think one needs to understand this in terms of really how you think about allocating capital with large U.S. companies, how you allocate capital in terms of credit, how you allocate capital in terms of rates and commodities, because I think this is going to have a big impact. And I know we at Apollo think about this to a much greater degree than we ever did before. We always felt for 15, 18 years we were a micromanager. If the company makes sense, if it has great barriers to entry, you can be less cognizant. We believe that's not the case today, that you need to be much more knowledgeable about this global cycle to a great degree. Before I get into some summary of my views, certainly I think that any investor that came to you today would talk about 5 or 6 global risks, which to some degree have been the same the last year or two and will probably be the same the next year or two. We live in a greater interconnected world. I was in the Middle East last week. A lot of varying views about where the U.S. is going as an economic and a global military power. But certainly the geopolitical is really the driver of what we live in the world today that's more interconnected. The second is monetary policy and interest rate risk. Huge question. I know when I'm sitting in your seats down at the Duke Endowment, we ask ourselves all the time, deflationary or inflationary environment, hard question to ask, but certainly one needs to confront. The third big risk today is liquidity. When I sit across from the largest CEOs of institutions in New York or around the globe in banks, they think about the markets, and the big issue for them is liquidity. How has the Volcker Rule changed that? How has it created much more challenges and risk to the marketplace? And so those are the big 3. In my mind, it's geopolitical, it's monetary policy and interest rate risk, and it's really liquidity. The 4th and 5th Income inequality, huge issue for us folks facing in the United States right now. We all have to be cognizant of it. Certainly the Fed and the Fed activity, I think, has only created a bigger disparity. And I think that's a problem that we all have to be focus on, because certainly we as an investor and how that impacts consumer spending and other attributes. And the last question is really hidden leverage. So once you get behind those 4 or 5, these are when I go around the globe, and I've been fortunate to be able to travel a lot the last 6-8 weeks, whether it's in basically all the major regions. Certainly, I think that the market has embraced that Europe is not growing like it should, and there needs to be a great quantitative easing. Certainly, if I was to sit down with Draghi for an hour or two, I would have a very strong view on what they need to do. But I think once that inevitable quantitative easing begins in the next 3 to 4 months in Europe, and I believe Germany is appropriately jawboning because they want to make sure that for their fellow country members in the euro that the proper fiscal restraints are put in place, I certainly think that's going to have a big impact on the dollar. And as my partners at Apollo really believe, we've probably been in business for 24 years, but if you get the 6 or 7 big moves right, and I certainly believe that the ECB is trying to get the euro-dollar parity to 1-to-1. I think that has a broad impact. I'm not saying they're going to be successful, but if Draghi could wave his wand today, I think he would like to do that. I think that would spur a lot of export growth around the globe, and I think that has an impact on a few things. One is, I think I'm not surprised that the 10-year went from 230 to 186 last week. I think when you look around the globe and you look at 10-year treasuries in Japan, in Germany, and other countries, 230 looks pretty attractive on a currency that has probably going up versus other currencies. So I think we're going to be in a zip code of 2 to 2.5 for a while. I think the black swan event is actually rates going to 1%, because I think that would take most of the market consensus and turn it on its head. But certainly I believe that the amount of debt around the globe right now, it's going to be a while before we get that massive inflation. What is the impact from that dollar? The impact from that dollar strengthening, it's not great for commodities. I think it's pretty poor for oil. As you'll hear me talk in a few pages, I think we are in this renaissance in America is wonderful, but I think it's going to have an impact on oil prices. I believe they will breach 80. I think they're going to probably test lower levels. And I think I'm probably one of more of my outliers at Apollo to think that. But certainly I think it's going to have an impact on what's going on right now with met coal, what's going on with iron ore. You're going to see it with commodities. And one of the questions we ask ourselves, is are we in commodities like we were in 06, 07? Are we on the precipice of a real commodity deflation trade that would have a big impact on the global economy? I think we have a mixed view at Apollo. I'm probably closer to being in that camp than I was 6 months ago, but I see what's going on with met coal. I see what's going on with dirty coal in the U.S. I see what's going on with iron ore, and it's really changing a lot. And I think that dollar impact will have an impact on returns, and it'll have an impact on rates. Finally, in credit, you've read about it in the last 4 to 5 weeks. It's a overbought market. Liquid markets are very crowded, and a lot of managers who have had large commingled funds. The reality is many investors who sit in your seats, they'd prefer to go in a large $5 or $10 billion fund for comfort and perceived liquidity. I think that actually compounds the problem, and it results in many investors having the same trades on. So it's not a surprise when Fannie and Freddie have their issues with the government 2 weeks ago, when there's a crowded trade like the airline trades or Ally Financial, or a big merger like Abbey V and Shire goes sideways, that there's a lot of correlations. Credit investors in the last probably 2 to 6 weeks are down anywhere from 2 to 8 or 9%. And I do think for a while that the idea of many investors wanting to have liquidity and rub liquidity and get comfort with liquidity, I think there's the returns in illiquid opportunities, committing to illiquid opportunities across a portfolio. There's a reason why the endowment model or the other models, if you have the long-term ability to commit to illiquid assets, I think it's really still the greatest opportunity right now in the overall marketplace. Those are some of my broad general comments. Let me stop here for a moment. I can get into some of these comments in much greater detail, and I'm happy to do so. But let me stop there to see if there's any questions from the board or from anybody else in the audience.
Yes. Apropos your comments about liquidity, well, as you know, last week the Federal Reserve called in the 10 largest banks in the country and delivered a very stern warning to them in terms of quote unquote their culture and their risk taking, and basically told them that if they didn't adhere to stricter internal regulation concerning their risk taking, that there would be no question that the Federal Reserve would ask for legislation or regulation to reduce the size of the banks. Having said that, if that were to proceed, there's been talk of reinstituting Glass-Steagall. Now, if that were to happen, and you took the banks basically out of the securities business, with the exception of back years and years ago, the only securities business they were in was a tax-exempt market. Do you feel that would significantly contract the liquidity of the corporate bond market?
Well, I do. I think that, let me go to one slide here. Let me take a step back to answer your question. I have been fortunate to be in the business since 1984, so I've seen the small firms become public, consolidated, and the breakdown of Glass-Steagall. I was at Citigroup when they did the whole Citibank-Solomon merger, so I saw the impact on that. I do believe that a lot of the regulatory headlines are a bit in the rearview mirror. This is a startling chart in my mind. This shows what the major Fed dealers, what their balance sheet is of corporate securities. And as you can see, in the peak in 07, 08, it was as high as $250 billion. And now it's down around 80%. So I think this is the reality of the corporate bond market today and the loan market today. And I think that there's much greater risk with a PIMCO total return fund at $250 billion at its peak and a star manager. That is a recipe for a real disaster. So in my mind, the theme that we've been talking about, your institution about, you're the bank of the future. And regulations, if you talk to JP Morgan, if Jamie Dimon were here, or the leadership of Goldman Sachs, or Michael Corbat from Citi, they would tell you that their business models are dramatically shrinking, and it may take them 3 to 5 years to change that culture of compensation and risk-taking, but that's the warpath that they clearly are on. And I think the real question for this group, and when I sit down with the endowment that I'm on and the boards that I'm on, it's that's going to be the environment. How's it going to impact how we allocate our capital and how we operate? Because the reality is, you are the long-term investor. The State Fund of Florida is the long-term investor. That Middle East sovereign is the long-term investor, and you should be providing credit to those institutions, not the banks. So I do think that that Washington is still going to continue to regulate financial institutions dramatically, and I think that it's no surprise that their return on equities are 8 to 10% at best. They're levered 8 or 10 times, or not levered at 30 times. So yes, I believe that regulation, I mean, the impact on attracting human capital to this enterprise from those institutions, better than ever. The ability to profit and to allocate, and I do think it's going to have an impact, as Alan and I were talking about earlier. We've been in a market where it's very macro-driven. Now you're seeing lower correlations in the ability to really invest as a micromanager, whether it's in credit, whether it's in long-short equity. I think that's good for investors. But I certainly think that the next big discussion will be how to regulate shadow banking. And shadow banking is what we all do collectively, but the fact is, our economy now, we are a $17 trillion economy. We've got the capital markets are about $50 trillion. There's a lot more debt in our economy than there ever has been before. I think that is a secular change. It's not going to change, but it's how one constructs their portfolio acknowledging that. So I hope that wasn't too long-winded, but.
No, I guess the other question I would have is the fact that, as you point out, that as we move into more and more regulation of the banks and removing them from their role in the increased risk-taking that they've undertaken over the years, which have been reduced, in some ways that could be considered a good thing. I mean, the 50 years from the time Glass-Steagall was passed, we had very few financial crises relating to banks except for their forays into real estate. So I guess the point of the matter is, as you point out, if you move banks into the area of utility regulation, is that a trade-off in terms of more stability in securities markets?
I don't know if it actually is. I'm not sure it is. I think that, as you rightly point out, banks were agents for 50 years, and then Glass-Steagall came along, and they became principals. And, it's no surprise that Goldman Sachs, and I'm not knocking Goldman Sachs, but they said, we had been a marriage broker, and now we're going to actually own that risk. And they took that risk on from 03 or 02 to 09. They took that risk on. And the backdrop is the global economy has gotten so much larger and so much more interconnected. And I know what concerns me is when I think about how volatile the market was in the various crises that I've been involved in, the 87 crash, the early 90s, the Mexican crisis, the Asian crisis in 97, the internet bubble. The markets are more and more interconnected. So last week on Wednesday, when the 10-year goes from 230 to 186, I mean, I can't describe the volatility. That's a 4 or 5 standard deviation move in one day. And I think you're going to see more of that because the banks are going to withdraw and investors aren't going to disintermediate one another. So I would expect more short-term volatility over the ensuing years in a variety of asset classes. I mean, the Treasury market is the deepest, most liquid, supposedly the safest in the world, and they had the price movement last week that would have taken the Dow down 3,000 points. That's the comparison. So I'm not so sure it's going to be a much more gentler world. I think you're doing what's right because the governments appropriately are saying we don't want consumers and individuals to have to bail out banks. Totally appropriate. That's just that's the proper governance. But to make that statement to say that's going to create much more calm and less volatile markets, I don't believe that's the case. I don't. I mean, I'll use oil as an example. I think oil is going to be in for a very bumpy ride here. You got countries in the Middle East. I was there last week. They may change a little bit their supply, but they have economies that need that revenue, and they are hooked on that revenue. And now you have the U.S. in a bit of oversupply. We've had a great renaissance, and a lot of companies have hedged in the U.S. So that tells me if you've already hedged 15 and 16, you're going to hedge 17 and 18 at 80 or 77. Why not? Why take the risk? You'll hedge it. So I think oil is going to really be in for a little bit of a volatile run here. The point being is we're in an interconnected world. I think that the regulation of banks, which is inevitable, I think it's going to create more volatility, and more regulated banks does not equal low volatility in the markets. So you, as an investment board, we would all love to see every quarter like 2.5%, 3%, 2.5%, 3%. I'm not sure that's the reality. I think we're in a lower rate and a lower return environment, but I don't think we're in a placid environment. And what concerns me is when it's some inevitable point in time in my career. I'd love to be retired, but I'm not sure that's going to happen. I think that we are going to see inevitable inflation, but I think it's several years out. I really do. And you'll want to own assets versus financial assets, but could be a ways out.
Jim, can you speak more? You talked about the banks and what's happening there with their contraction and that replacement of capital via shadow banking.
Yeah.
Can you maybe speak to the growth of that segment of the market?
Sure. I don't think it's a surprise that since the crisis, there have been a handful of firms like Apollo, whether it's KKR, Blackstone, or other, that have grown their businesses to fill in this vacuum. You know, we're entrepreneurial folks. We have great investors, so we have filled that gap. I think what Herschel's question really asks, I think you're asking, is where is there too much capital? Where is this tsunami of capital that has overtaken the opportunity set? And I think that there are some strategies, whether it's, individual corporate distress in Europe. I think there's way too much capital there. I think there's some special direct lending businesses in the U.S. that have been overwhelmed with capital. But I look at a lot of businesses. I do think energy credit, I still think we are in a renaissance. I think the low price capital has created a lot of opportunity there. We talked about Amazon. I think it's allowed businesses that don't have earnings to go on for a lot longer. But it's hard for me to specifically identify. There are parts of the market, Herschel, where this shadow banking system, I do think a lot of the ETFs and closed-end funds are problematic structures where you have too much capital trying to buy an index. So what we're doing is we're trying to really be much more in front of the origination. But I find myself confronted with reallocating capital in vehicles on a much greater propensity now, where you could lean into an asset class for a year, where I say I lean into an asset class for 3 or 4 months and then pull capital out. A great example is the CLO liabilities. We're a big player in that. 6-8 weeks ago, I said, okay, guys, I want to get out of single Bs and double Bs and go into triples and single As. And it took us a while to do that, but you have to be much more on your feet in these markets because there is a degree of overcrowdedness. But I don't think we're there yet. I still think the amount of alternative capital, when you add up all the bank capital and the balance sheets in the U.S., Herschel, the 4 big banks are about 50%. Bank balance sheets in the U.S. are about 16 trillion, basically 1 times the size of the economy. There still is a lot of savings in the U.S. The U.S. is a net saver, 7-8% the last couple of years. So I don't sense that it's gotten more competitive because we're in a low rate environment, and there are certainly some asset classes that are overwhelmed with capital.
Going back to Europe for a moment, your comments, if I understood you correctly, you seem to be express some optimism on Draghi's ability to engineer a better recovery. But I guess the question that I would have would be, is his ability to increase monetary expansion to encourage growth enough and in the short run that may work very well, but will it be enough to overcome the structural deficiencies in places like France and Italy, which there's been no growth and there will be no growth unless they're able to change their entire attitude towards governmental regulation and the ability for the private sector to do better?
The answer to your question is it's going to need both. Spain and Ireland are two great examples. Ireland is the best example. Ireland has taken the bitter pill. They've passed a lot of domestic legislation. They've allowed foreign capital to come in. And Ireland now, it's a much smaller economy. You know, it's 3 million people. They had, but certainly they had a tremendous housing bubble over the 10 or 15 years. But if you're in downtown Dublin right now, you see you know, a lot of great growth, and I think it's transitioning to the countryside. The real question is, when I sit down with the regulators in Spain and Italy, I think that they have taken advantage of the crisis to a great degree to invoke a variety of legislation. I think their big concern is Spain and France have done very little. Excuse me, Italy and France have done little. Italy a little bit, France has done nothing. They did not use the economic crisis as political leadership to push through the reforms that need to take place. So the answer to your question is, it's going to take both. Monetary policy on its own cannot solve the problem. There needs to be a recognition that these countries need to pass a variety of generational change laws, invest in education to create that environment. And I agree with what Merkel is doing by saying that there needs to be she'd prefer to have domestic policy changes rather than monetary changes. But I think you need both. I don't think, I see what's going on in the U.S. and other countries, and I think you need to, you know, these countries need to invest in education. They need to change rules about starting companies. They need to change rules about letting go employees. They really need to take some of the economic renaissance that, you know, we've been fortunate to do in the U.S., but, you know, now we've gotten to a point where we have income inequality. So Europe is going to be confronted with massive income inequality and a massive immigrant population, but they need to do both. The countries that have succeeded have done both. There's no easy way out. So that's the end of my prepared slides. I mean, certainly my which is attached to the presentation, which I think you have, is, you know, I think our view, strong growth in oil in the U.S., great economic renaissance. Certainly, I think that it's been spurred on by a low interest rate environment, but great technology, great engineering, great entrepreneurial ability. And as you can see on the bottom, I think that we think a long-term range for WTI is in this 80 to 90. I believe it will pierce the lower end of that for some time. I'm not sure about Brent, but I think there will be some economic impact from this lower rates, higher dollar, and the impact on commodities. So that's a strong focus that we are very much in touch with, and we're a big investor in this asset class. You can see this is just the forward curve a little bit. You know, if the forward curve was dramatically lower, that would be of greater concern. What's really just happened is the current curve has come down in the front end, which, you know, again, I think the curve is flattened, but it's it's a longer term issue. This is what I was talking about earlier in terms of the early stage of deleveraging. We would argue that Japan took 10, 11 years to do from the peak. You can see where Western Europe is. We're only, you know, 4 or 5 years into it. I think it's a 10-year deleveraging. I mean, basically in Europe, the two numbers you should know: 18 trillion economy and 50 trillion in financial assets. It just has too many financial assets in the hands of banks, and they need to get that capital out and into investors' hands to take that proper risk. This is when I talk about the dealer inventory and the impact on that credit cycle. There will be volatility. It's a question of how it gets put forth. And the last two pages are, you know, people think that there's not been any distress in the U.S. I would say that's a mirage. I would say that the indexes do not reflect it because the markets have gotten so much bigger. But if you own debt in any one of these 30 or 40 companies in the last year or so, there's been great distress, certainly massive disruption by technology in the retail space across the board, massive disruption in the coal space. So not a lot of great companies here, but certainly companies that issue debt that will be restructured. And the same in Europe. The view is that there's nothing happening in distress in Europe. There's a lot of companies that, whether it's BES, the Portuguese bank, Phones for You, Edcon is a South African retailer. There's been a lot of credit distress in Europe. So it's underneath the headlines just because there's not the massive names like First Data and Clear Channel in the past. But there is a variety of opportunity that gets back to credit dispersion, which I think is good for the market. So, overall, we are very, very cautious on private equity right now as a firm. We have a very large fund. We're very patient. We've invested most of our capital, about 20% of that fund, in energy thus far, but we do not mind being very patient. We've been a net seller. We've returned around $30 billion of capital to investors in the last 12 months. And in credit, we have a view that we want to take advantage of this secular change and change our business model to be much more of a provider and originator of credit. But at the same token, we think that there is going to be volatility ahead. So we are extremely patient right now, and we have a lot of dry powder, which plays into Herschel's question earlier. Is there too much dry powder on the sidelines? There's no doubt there is a tremendous amount, but it varies by asset class. And I really applaud this commission for being visionary 6 years ago, to setting up a handful of these relationships. Certainly some have done well, some have not done as well, but certainly in our view, this is what the most thoughtful investors around the globe are introducing to their portfolios and having them play a role. It's not the complete solution, but it's part of a solution, and we applaud that. So.
Mr. Chairman, if there are other questions?
Maybe an update. I know last time you were here, you talked a little, maybe I think about shipping or something. What's kind of going on in that space?
Shipping is a good example of a tremendous amount of chatter and talk and capital formation without that much activity. Just quickly, for those who are not up to date, basically the U.S. energy renaissance has changed shipping and cargo in and out of the U.S., iron ore in China and other things. So the global shipping sector has been under enormous pressure the last 3 to 5 years. You got countries like China, even though going from 3,000 yards to 700 yards, a lot more product on the marketplace. Mm-hmm. And so if you look at shipping rates, cargo rates, they are at 10, 15, 20-year lows across the board, except in the last 3 or 4 weeks they've actually gone up quite a bit. We've bought about 15 ships as a firm. Thought we were stealing them. We'll end up making like an 8% return. It's been very tough. The reality is the German banks that are sitting on billions of bad loans have not sold them yet. And only when they start to sell, which, we've bought a couple of snippets, but we've probably as a firm put 500 to 800 million in shipping. I would have thought we would have put a couple billion right now. But the real actionable opportunity has not happened there yet. We are forming. We have formed a variety of joint ventures around the globe. We have a shipping venture with a group in Germany to do things like that. We announced last week a group of folks who are very experienced in retail liquidations in the UK. We started a venture with them. We bought a healthcare finance company in the U.S. a couple of years ago that we're creating a business around, that we were talking to your team about, called MidCap. So in our view, you want to have this industry expertise as the banks are changing, but some you have to set up ahead of time, and some you just have to be very patient with.
Can I just add that some of the shipping strategies that we've implemented too have been less on container and more specialty shipping as well. And so you've actually seen quicker price appreciation for the day rates there.
Yeah.
And you've been able to arbitrage out some of the optionality for getting newer ships off out of the China yards or Korean yards as well at a much lower price, because of when they were stressed, they were looking for the revenue. So you can actually get new delivery of ships at 20 to 25% discounts in the specialty shipping area. Cargo is still
like LNG or chemical or some very specialized, and that's that's another way to play it. But again, it's when you think about it, this is all about getting much more granular in expertise and not making a macro beta play.
As a corollary of that, a couple of days ago, FedEx announced that at year end, they would be raising prices 4.9%, which is a significant increase. Is there any sort of correlation, or can you make any relationship between that, the movement of goods, and obviously the shipping business is an entirely different business, but it would seem to me that when you're talking about moving goods, and one of the prime participants in that business can increase prices 4.9% if they can make it stick, that's a pretty significant move.
It is, and I guess the corollary I take away from that is there's been a variety of ways to make money around the energy renaissance, other than just being in the shipping, other than being in the oil business. Mr. Buffett bought Burlington BNSF at exactly the right time. The rail renaissance has been tremendous in the U.S. to benefit off of that. I will tell you, we have a business that buys old aircraft and refurbishes them and leases them off to a variety of cargo carriers. Tremendous demand from UPS and FedEx for a product like that. Whatever we can find for them, they'll pay for the refurbishment and sign a 10 or 12-year lease. So I think what you're seeing is the retail market changes dramatically from bricks and mortar. I think companies like FedEx and UPS are benefiting, and their constraint isn't customer demand, it's being able to respond with the proper infrastructure, and I think that's what you're seeing. I think they have there's a constraint in physical supply, and I think they can extract that. It's a business model. So aircraft's another space where the European and Asian banks used to be the big lender to aircraft, not just new, but 5 and 10 and 15-year-old lease aircraft. We have a big business now that takes that lease risk. And we like that. We think it's not correlated. We think it's less correlated, and we think we can use intellectual capital to create interesting returns. They're not traditionally private equity. It's not 20%. It's not fixed income at 3%, but it's this 10 to 12% return that we think is very interesting and attractive right now if you can structure it properly. Well, again, thank you for your partnership. We appreciate it. We hold this in New York. South Carolina is really it was our first major strategic partnership. We've had a dozen to 15 follow. This is always the first one, and there's a tremendous amount of professional pride we take in partnering with you. So we thank you very much.
Thank you.
And we're remiss we did not introduce Barry Cohen, who's actually a key person of our strategic partnerships as well, to keep all the trains running and constant dialogue of typically weekly meetings. So thank you as well, Barry.
I thank you as well. I was remiss. I apologize.
Okay, so next, I believe I'll have Brian Moore to the left, the Grosvenor to this one. You want to get him? Okay. So next is Grosvenor. If the Commissioner will recall, it was one of the first hedge fund to fund investments that were made probably 6 years ago now, somewhere in 2007. So I guess that's actually 7 years ago now. And this is one that we converted into a strategic partnership, and we used the hedge fund to fund as a liquidity vehicle to fund opportunistic investments. And so we've been fully redeemed from the hedge fund to funds component. And are they?
Yeah, they're on their way.
On the way? Okay.
Yeah, they're walking.
Okay. And so we've converted to an opportunistic strategy. So we'll have the team walk through that. Also, I've asked Brian Moore, who works closely with the Grosvenor team, to make the introductions. So while Brian's at the podium, we have Grosvenor team coming in. And so Brian, I'll turn it over to you.
Sure. Well, I'm pleased to be here today and to have the chance to introduce our main guest speaker from Grosvenor, Mr. David Richter from Grosvenor. Mr. Richter is the chair of the investment committee Director of Investments and Head of Manager Research for GCM Grosvenor Public Markets. In his role, Mr. Richter approves portfolio allocations and shares responsibility for the evaluation, selection, and monitoring of various investment strategies and managers. Mr. Richter also serves as one of the 2 investment committee members from Grosvenor for the GCM Palmetto Strategic Partnership. Based on a few recent high-profile developments, such as the CalPERS decision to eliminate its hedge fund allocation and his proximity to the hedge fund industry, the RSIC team felt it was appropriate to invite Mr. Richter to update the Commission on trends in the hedge fund industry as well as a general market overview. We also have here Pat McGarvey, who is our main relationship person from Grosvenor, who I'll pass the torch over to give a brief overview on Grosvenor, and then we'll pass it over to Mr. Richter. Thank you.
Thank you, Brian. Good morning. I'm Pat McGarvey. It's nice to be with everybody today. Grosvenor has been providing investment management services to South Carolina since September of 2007. It's been our pleasure to work along with staff as well as the Commission in a initially direct investment capacity, and then since 2011 in a strategic partnership capacity. We've been in the hedge fund business since 1971, so almost 43 years now. We recently bought a business in January of this year in the private equity business to complement that business. We have close to 300 people devoted to our hedge fund business and 120 devoted to the other businesses. A few of our distinguishing characteristics are our people and our culture, which we're very proud of, the consistency of our management, which has been together for approximately 20 years, and our focus on creating customized investments for clients like you. Our guiding principles are: we seek attractive risk-adjusted returns across all asset classes and markets. We leverage our size and our industry relationships to benefit our clients in all capacities. We provide innovative investment solutions that are tailored to our clients. We don't believe in one size fits all. We try to be sensitive to everybody's individual needs. We believe we deliver world-class client service, which we think is also important. And we always act with integrity and look to take care of our community. If you look briefly at the second page, I just wanted to give you an overview of the business today. The business on the left, the public markets business, is our hedge fund business, as I mentioned, established in 1971. We serve a decidedly institutional client base. The vast majority are pension funds, sovereign wealth funds, and institutional investors of other types. The business on the right is the business we recently acquired from Credit Suisse First Boston, and we call the private markets business. David?
Thanks, Pat. Hello, everyone. Thanks for having us today. As Brian said, I am the chair of our investment committee at Grosvenor. I've been at Grosvenor just under 21 years investing in hedge funds. So I feel fortunate to be here today and give you a bit of a hedge fund industry update. So it won't be a Grosvenor pitch in any way, and happy to take questions. I'm just going to take about 10 minutes, 10, 15 minutes. We have 8 slides to give you a bit of an update on the industry. That is the first one. And then, of course, feel free to ask questions during or after. So the hedge fund industry continues to grow. This data, which is the most recent data, came out 2 days ago, actually, by HFR, which is a firm, independent firm, coincidentally based in Chicago. And what it shows is that assets in the hedge fund industry are at an all-time high right now, $2.8 trillion globally. And that inflows have been positive for the third quarter of 2014 and actually for the last 8 quarters in a row. So why? Why are assets at an all-time high in the hedge fund industry? In our view, there are a few reasons. First of all, asset prices are high. Equity markets have risen, fixed income markets have risen, interest rates are low. There's downside risk in equities and bonds, and institutional investors like what we call the asymmetric profile of hedge funds. So what does that mean? We believe that the downside in terms of broad markets, relative to broad markets of investing in hedge funds, is much lower. You sacrifice some of the upside in good markets, but the recipe of having lower downside and reasonably decent upside is a recipe for long-term positive performance, and also allows us to kind of sleep at night and feel that the hedge fund allocation has a lower correlation and lower volatility to traditional assets. And that's been the case for many years, actually over all reasonable measurement periods, including 2008. And another reason is that the talent in the industry is higher today. There's been changes in regulation, such as the Dodd-Frank Act and the Volcker Rule, which does not allow banks to have proprietary trading desks to the degree that they did, and a lot of the prop traders that were the biggest competitors to hedge funds for the last 20 years have migrated into the industry. The terms and fees and transparency are all better in hedge funds than they were in 2008 and prior. So we'll get to that in a minute. But the alignment between, everybody learned from their mistakes in 2008, and the alignment between the hedge fund manager and the investor is much better today, and we'll give you some examples of that. So pension funds and consultants globally and CIOs have all embraced hedge funds and have increased allocations, notwithstanding the CalPERS news, but the data that's public, as well as our own data from our own inflows in our firm, corroborate that assets are increasing. This slide simply is just the number of funds. This 8,367 hedge funds you could see in the upper left, excluding fund-of-funds firms. And this is why it's hard to make general statements about hedge funds. Some are risky, some are not risky, some are big, some are small. So there's 8,367. We invest in 147 at Grosvenor, so obviously that's a small window, so we have very high bar for approval. And there's a lot of dispersion in hedge funds, even within strategies. Some are quite good and some are not so good within any strategy. Another trend you could see here is that there are fewer launches. And the reasons are, number one, regulation has gone up. It's expensive to launch a hedge fund. You need a lot of compliance, infrastructure, and regulatory capabilities. And also, it's harder to get institutional investment, because investors are more discerning today and have a lot of choices, and so it's hard for hedge funds to raise capital. This slide shows trends that are reported by Preqin in a global hedge fund survey they did in 2013 to go into 2014. And a lot of words here, but the bottom line is that going into 2014, 92% of institutional investors planned to either maintain or increase their allocation to hedge funds, and for the reasons that we mentioned on the previous page. So why are they maintaining and increasing? These were their goals. And again, you could see that all these columns, except for this one is high return. But most of the reasons here are lower volatility, lower correlation, more diversification. Investors feel plenty long in equity markets, plenty long in bond markets, and they want a piece of their portfolio that is going to be different, with different exposures, different return sources, different sources of alpha than traditional assets. And that's the main reasons why you could see there 71% of the respondents to the survey. So I mentioned about improved partnership or alignment between hedge funds and their investors. And what did I mean by that? Well, there's 7 items here shown here. This is an important trend. I've been doing this a lot of years. I've seen a really nice trend over the last 5-6 years. In fact, we have pushed managers, we, Grosvenor, other firms like us, and institutional investors like you have pushed managers for better transparency, better structure of fees, lower fees, and more alignment. And so we've ended up in a better place. And there are investment improvements, which really are kind of numbers 1 through 4, and then there are structural improvements there that are number 5 through 7. Fees are lower. One of the things that we do in our strategic partnership with you is to try to drive fees lower and pass those savings directly to you and your plan participants. And we've done that, and that's a nice thing. Same thing with transparency. We use independent third-party risk aggregators, but we also have proprietary transparency systems and risk systems where we model out the portfolios. How will the portfolios do in a tough market, in a crisis, and so forth. A lot of that is available now with good transparency tools. And the same thing with liquidity. The market is not necessarily more liquid than it was in 2008. But the hedge funds have better liquidity because they're doing less things like private investing and side pockets and gates and some of the things that you read about in 2008. Now there's much more of a match between their underlying investment portfolios and the liquidity provisions that they are offering investors. And so that's a good thing. And of course, the alignment is very strong between the hedge funds and the investors. They don't get any incentive fees unless they earn profits. We are aligned with our investors, such as yourselves. We have our own money invested alongside you. I have my personal money invested, not because our company makes me, but because I like to have a good risk-return profile with low risk, and I sleep well at night also. The strategies, we don't have to go into these. You're probably all familiar. We just wanted to kind of show you that and explain that they're not always so complex, which is a little bit of a misnomer, we think, in the media. The left 2 columns there, equity and credit, these are more offensive return-seeking strategies. These are largely similar to traditional assets, with the exception, really, that they can go short and they can do a lot more hedging than traditional mutual funds and long-only funds. The 3 right columns are a little more complex, and that is where they're more defensive, they're lesser correlated, they're in the portfolio for ballast to protect in the downside. And they are more complex, and they require a lot of resources. That's why we at our firm have so many resources. We try to be an extension of staff to South Carolina and other institutional clients. And this, we have 2 slides left. This one is the arguments for hedge funds are persuasive, at least in our view. And both empirically and anecdotally. And as I said, number 1, attractive risk-reward profile, lower downside, and that's been the case, and we even saw that this last month, frankly. And number 2, structural advantages. Hedge funds don't have a benchmark that they have to stick to. So if there's a sector, this year healthcare has been an interesting sector, a lot of change in that industry. Energy, another one, a lot of change especially in the U.S. energy sector. So hedge funds, they don't have to stick to a benchmark. They can move capital to sectors that are more interesting. They can take hedges if they're worried about the market. That's the structural one. Strong, stable managers we covered. Most of the firms with whom we invest are real, you could call them hedge funds. They are real global asset management firms with offices in multiple countries, big teams that have skills in different strategies, and a lot of infrastructure for risk management. And then, of course, number 4, favorable market environment. It's not necessarily favorable in general. I mean, we all know that it's a scary world out there, a lot of geopolitical risks, a lot of macroeconomic risks, a lot of risks in general. But for hedge funds that can take advantage of change and dispersion, some countries are tightening and increasing interest rates, and some are loosening, and different asset classes are decoupling a bit versus the last 5 years. And that environment should, in our view, be positive for hedge funds that can kind of use their research to take advantage of the winners and losers. And then lastly, why now? I think I just kind of said that. Basically, The difference is that you've got on the most liquid end of the spectrum in money management, you've got mutual funds and long-only funds. They are benchmark centric, and this is not a disparagement. They're good, but they have benchmarks and they have to stay liquid. And then on the other side, you have private equity and private debt, which are also good, but they have to, they're kind of 8-10 years plus. They're illiquid. In that middle spot there is a little bit less crowded, and that's where hedge funds play. It used to be hedge funds and prop desks, and now it's really mostly just hedge funds, and that's why there are opportunities there, because it's just a less crowded space, and there's especially in certain sectors and strategies, there's more to do. We have a bias at our firm, and many other firms do too, but we do for fundamental research. We don't like a lot of leverage. We don't like black box type of opaque strategies. We like fundamental research-based strategies, and we like investor-friendly terms, and we try our hardest to get you those investor-friendly terms. So that's it. The only other thing we have that might be interesting, I'm not sure if we have time, but is what we like today in terms of the strategies, and we wanted to just give you one page on. Do we have time for that? Herschel, yeah? Okay. So just real quick. 5 themes we like today on the right-hand side of the page. Just those five blue captions. Opportunistic credit. This is non-traditional credit. This is not high-yield bonds, not investment-grade corporate bonds. These are, for example, European banks feeling pressure from their regulators to sell assets. So you can kind of go in there and buy corporate loans or mortgage assets, do what we call regulatory capital relief trades with these European banks. These are a little bit less liquid, but they're interesting. They have a yield, and they have got a margin of safety. They're backed by collateral. That's one of the areas. Specialized equity are mostly either the word specialized means either a sector or a region. So I mentioned healthcare and energy. Those are 2 that we like. Shipping. Activist is kind of an interesting area, mostly in the U.S. and in Northern Europe. It's not necessarily a global phenomenon, but activism is friendly, constructive activism is what we prefer, not hostile litigation. But that's an interesting area. The third one, direct opportunities, is a best ideas format. This is interesting. We've been working with South Carolina on this for years now with good results. These are isolating the hedge funds with whom we invest, isolating their best ideas into customized vehicles with more favorable terms to try to capture their best ideas, because we sit in a good seat where we have relationships with some of the world's best money managers. Event-driven, these are spin-offs, restructurings, bankruptcies. There's not as much to do here. We wish there were more to do. Well, maybe I shouldn't. You should be careful what you wish for. We're not wishing for bankruptcies, so I didn't mean it that way. But there's just not a lot of activity here. But should there become more of this, we would pounce on it. And then finally, a real interesting one is relative value here. We're worried about volatility going up, and we're worried about interest rates going up. And so we can put in investments that are designed to profit if those things happen, and we've put some of that in our portfolio, and that's just that's another advantage that we can have with a flexible mandate. So that's a quick summary. Be happy to take any questions if there are any.
Oh, good.
Obviously, there have been periods when hedge funds over a 10-year period have had extraordinary returns, and over the recent past, there's been underperformance. What would you attribute the recent underperformance in general? Now, obviously, there's going to be a significant difference between hedge funds, but in general, hedge funds have underperformed. One of the suggested reasons for that has been, as you alluded to, it's become a very crowded space. Do you have any comment on that?
Well, there have been periods of underperformance. I mean, I would not call 2014 one of them. We had very strong performance then and in general, but over the last few years. But definitely there has been some underperformance, especially relative to the older days, where hedge fund and it is partially due to crowding. There are the strategies that are susceptible to crowding can be on the short side, which is an important side. Used to be that with interest rates, short-term interest rates about 5%, a short seller takes his or her portfolio and puts it into cash basically and earns 5% right out of the box. And today, zero, because interest rates are zero. So there's been structural changes. There have also been some improvements in accounting in the U.S. with Sarbanes-Oxley that have, believe it or not, and I know there's exceptions to this, believe it or not, have been a little bit harder for hedge funds to find those kinds of frauds and failures that they used to find. But there are still plenty of overpriced stocks. So we've not in any way given up on short selling, but it's a harder space. Some of the strategies have become more crowded that we've actually moved away from, like some of the merger arbitrage and risk arbitrage strategies, statistical arbitrage where they've got computers that are doing a lot of algorithmic trading. We don't really do that anymore. But if you had to make a generalization about hedge funds, which is hard to do, by the way, because they're so different. I mean, the returns, for example, that you read about in some of these CalPERS articles are, different than what we see. But in general, I think it's bull market underperformance, where hedge fund managers are more conservative, and they're worried about the markets, and they put on a lot of hedges, and then they underperform. And then they get rewarded a little bit if the markets fall in terms of relative performance. But I think that's the time periods where they've looked worse is really those big advancing markets.
A question that's kind of down a similar path. It's really kind of two components of it. But one, the smart beta strategies in the market, which I know are not a direct replication, but some do look to take a look at replicating the factors of the hedge funds. And more of a pure passive. I'm just kind of curious of your thoughts on what you're seeing in that market. And then that kind of leads into thinking about that from isolating the true alpha out of hedge funds and making sure you're paying for the alpha component to it. And how do you guys relate that in your investment process?
It's a great question. We've studied that heavily, as you would expect. The replication products thus far have not been good performers. They've actually done poorly. We don't really think that they're very efficacious. They are backward-looking models that use proxy indices to try to replicate hedge fund strategies, and by definition, they're kind of moving away from the alpha source. The alpha source for hedge funds is human beings. The type of funds we invest with are funds where they are hiring high-quality people that are well-educated with good backgrounds, that are doing research and finding things that they believe are undervalued versus things that they believe are overvalued, and they're forward-looking. So we'd run all kinds of statistical models at our firm and optimizations and things of that nature. And if you do that, whatever's worked great over the last 3 years is kind of what you should do forward, but that's not necessarily true. For example, high-yield bonds. High-yield bonds have done great over the last 5 years, and so that's what maybe you should load up on that. But should you right now, where where they're trading at 105 cents on the dollar at a 4.5% yield? Not so much in our view. So that's a reason why you have to continue to be forward-looking rather than backward-looking. And by the way, I don't mean to minimize backward-looking. We do think past performance is important. We use it. We look at it. But it's a blend, and there's a lot of judgment involved. And so when you get into these replication products, what you get is really more, you don't get that forward-looking alpha vision. And also you end up with they try to be liquid, and they end up with using a lot of different futures and indices. So they claim to be fairly transparent, but they end up being more of a black box in our view than a lot of hedge fund strategies, because they've got a lot of computer models, and they're using all kinds of futures and indices and ETFs to try to create hedge funds, and you end up having difficulty explaining exactly what they're doing. So not to be too disparaging, by the way, I think they've been improving a little bit, and someday they might be good alternatives, but at the moment we're not really bullish on them.
Will the introduction or the ability of retail investors to participate in hedge funds, will that, do you think, over a period of time, increase volatility and possibly create some instability? Retail investors obviously are more prone to buying high and selling low, and the ability of them to get in and out of hedge funds, what effect will that have on the hedge fund
I
industry?
think it will increase volatility. The ETF, the retail community, ETFs, and high-frequency trading, HFT, and algorithmic trading, generally program trading, those things can have and can increase volatility. And then there is the issue of liquidity, which has there are a lot of data points recently where the market has lacked liquidity in certain areas. This is not a hedge fund issue. The mutual funds that are daily liquidity, mutual funds that are investing in fixed income instruments, it's possible that they have a little bit of a mismatch also. And so I think that the answer is on the negative side, increased volatility and slightly decreased liquidity because of the Volcker rule. On the positive side, for hedge funds, it tends to cause overswinging. So when there's a bit of a panic or a crisis and volatility is rising, things tend to overswing on the negative, and hedge funds are pretty healthy. We don't use a lot of leverage. We don't use leverage at our level, but even the underlying hedge funds don't use a lot, so they're healthy and they can kind of dive in when things are ugly. And so, and vice versa. So I think there's positives and negatives to that, but I don't really view that as a hedge fund issue. And by the way, hedge funds have run at a much lower vol than traditional funds, even in recent times.
It may be informative, just to tell you a little bit about our business historically, which has been decidedly institutional. Essentially 95% of our AUM really since inception has been with large institutions like yours. And that's, I think, partly a reflection of building personal relationships with sophisticated investors. But also, I think the benefit, which we saw clearly in 2008, is we did not have a flight of capital when things got tough.
Any other questions, comments for these gentlemen?
And then, just as a reminder too, that the portfolio level review will be an executive session, as there may be material information there, non-public information. So I did want to remind everybody that there will be a Grosvenor Part 2 as well as Apollo Part 2 coming up as well. So if there are no other questions, I think we could move to the next agenda topic, which actually says break, but I'll turn it back over to the chairman.
Thank you. We're running a little ahead of schedule, so our lunch, I understand, will be here at 11:30.
Right.
So we've got a little bit of time. What, do we want to talk about something else? Sure, I mean.
Sure. Personally, today's my anniversary, so if I can get back, that would be viewed positively.
What's this, number 5, Alan?
15. Put a 1 in front of the 5, right?
You better not be late.
You're right.
I congratulate you for remembering.
Yeah, right.
We can go, we can go into executive, the next would be, past the break would be executive session.
Well, I mean, if we go into executive session, that's going to take more than 15 minutes. We can go in and then break.
Yeah, we can go to break and then, like.
Do a break and come back into
All right, you want to go into a break now? Is that what you're saying?
Well, no, I was gonna say, why don't we do the first presentation and executive, the first, and then maybe take the break and then come back and do the second.
Okay, since we are running ahead of schedule, we will may I have a motion to go into executive session, and we'll deal with that, and then with the first issue, and then we'll come back out and break for lunch. So may I have a motion to go into executive session? Second? All in favor? Aye. Okay, we will.
There are 3 bases: to discuss investment matters, to discuss personnel matters pursuant to South Carolina Code Section 30-4-70A1, and to receive advice from legal counsel as well.
All right, we will enter into executive session. So who do we want to keep?
For the beginning, we would need the Apollo folks.
And we are going to proceed with, I think, the treasurers want to make a statement. Excuse me, I guess, first of all, I should tell you, this concerns the Azalea investment.
Chairman Giobbe, I recently discovered that a member of the unpaid advisory board for Azalea Capital contributed to my campaign fund. The contributions were properly disclosed under the applicable campaign finance laws, were legal in all respects, including they were under the allowable limits of the Securities Exchange Commission, and did not create a conflict of interest in my informed opinion. Even though the contributions were legal and ethical and in no way influenced my judgment, objectivity, or impartiality, out of an abundance of caution and in an effort to avoid even the slightest appearance of impropriety with the South Carolina-based entity, I hereby recuse myself from the vote of the Azalea Capital matter. Thank you.
All right. And Mr. Weinstein, you have a motion to read to us?
Yes, sir. Thank you, Mr. Chairman. The motion with regard to the investment recommendation for Azalea Fund 4 LP and the co-investment vehicle is as follows. Subject to the terms discussed in executive session, adopt the recommendation of the CIO regarding the investment in Azalea Fund 4 and the co-investment vehicle.
Having read that,
I'll make the motion.
Make a motion to,
Well, I guess someone has to make that motion, right?
Right, you're making
Yeah,
that
so
motion.
I'll make that motion.
Yes, sir.
all right, do we have a second? Any further discussion?
Yeah, I would just like to make 3 points. First, on this investment, our investment consultant, HEK, has rated Azalea with a conditional pass on operational due diligence. Our own operational due diligence team has uncovered numerous back office shortcomings and has had to facilitate helping them identify their minimum levels of policy, procedure, valuation, and compliance, all of which have not been reached in full yet. Even if these conditions are met, our consultant HEK's final rating is still not a buy for this manager. Second, they have in place a management fee offset terms which are not industry standard, resulting in higher than normal management fees. And again, our consultant HEK has rated this particular aspect as a negative. And finally, there are 2 commissioners that have identified relationships and or conflict of interest, and one has completely recused himself. But as similar relationships have occurred in the past with an investment, and the SC Ethics Commission has made very clear that in its recommendations that we should take all precautions to avoid any appearance of impropriety. And I just wanted to make those points as, you know, this is why, as a result, I will not be providing my support for investment of trust fund monies into this manager.
Any further discussion? If hearing none, all those in favor of investing in Azalea Fund 4, please signify by saying aye.
Aye.
Opposed?
Nay.
Nay.
3-2. 3-2, and 1 recusal.
All right. All right, well then we can move on to, Michael, do we have to say anything further?
Yes, sir, we've got that. Yes, sir.
I can read the motion. Did you want to read it?
Oh, sure, I'll read
All
it. One final motion, Mr. Chairman, and this would be for the commission, a motion to approve and deem HEK's fiscal year 2014 compliance report and supporting documentation as acceptable for purposes of the RSIC's compensation policy. Authorize both, 1, the aggregated performance incentive compensation amount, and 2, the CIO's performance incentive compensation payment as presented in the supporting documentation providing in the material in front of you, and direct staff to take all steps necessary to effectuate disbursement of the performance incentive compensation payments consistent with the compensation policy. Instead, need somebody to make that motion.
I'll make the motion.
Make a motion to approve, okay, and a second. Second, any further discussion?
Mr. Chairman, I just want to make one remark.
Yes.
I'm going to vote in favor of this proposal, but I regret that we've been put in this position by what I consider an irresponsible budgetary process that says that we can't pay our people what they deserve to be paid. And there are not enough funds available for us to pay our fine investment staff what they have earned. And I'm going to vote in favor of it because the alternative is for them to get nothing, which would be even less than what they've earned. But anyway, that's my position.
Any further comment or discussion? All right, hearing none. All those in favor of the motion signify by saying aye.
Aye.
Aye. None opposed, I believe it's, did you vote?
Yeah, okay.
All right, so it's
Unanimous.
unanimous. All right, so no further business coming before the commission. I'll entertain a motion to adjourn. Second? So moved, and we are adjourned.
Happy anniversary.